You keep hearing it. The Fed is raising rates, or Congress passed another stimulus bill. But behind the headlines are two powerful levers that shape the economy, and every model built on top of it: monetary policy and fiscal policy. In this episode of Concepts Every Modeler Should Understand, we'll break down what each policy tool does, who controls them, and how they ripple into forecasts, valuations, and business decisions. Monetary policy is controlled by a country's central bank. In the U.S., that's the Federal Reserve. Their goal: control inflation, stabilize the currency, and support employment. Their main tools: setting interest rates, the federal funds rate; open market operations, buying, selling government bonds; quantitative easing or tightening, reserve requirements for banks. When the Fed wants to cool down inflation, it raises interest rates. Borrowing gets more expensive, spending slows, and demand drops. Fiscal policy is driven by the government, Congress, and the president, not the central bank. It's about taxing and spending to influence the economy. That means stimulus checks, infrastructure bills, tax cuts or hikes, public investment. During COVID, governments used expansionary fiscal policy. They spent big to stimulate demand and sent checks directly to households. Here's the twist: these policies don't always work together. The government can be stepping on the gas with stimulus, while the Fed is slamming the brakes by hiking rates. That tension creates noise in your models. And it's why modelers can't just follow one lever. They need to watch both. There are three reasons modelers should care. 1. The assumptions get rewritten. If the Fed raises rates, your cost of capital changes. If Congress cuts taxes, demand might spike. Either way, your model inputs aren't stable anymore. Number 2. Sector sensitivity. Monetary policy hits interest rate sensitive sectors: real estate, autos, lending. Fiscal policy drives government dependent sectors: defense, education, infrastructure. Number 3. Timing and the lag factor. Monetary policy can work fast in markets but slow in the real economy. Fiscal policy takes time to pass, but can hit hard once it lands. Modelers should factor in policy lag when building forecasts. Let's take an example. Let's say you're modeling future revenue for a construction company. A new infrastructure bill passes. Fiscal policy boost. That means higher expected demand. But interest rates just jumped 100 basis points. Monetary tightening. Borrowing costs go up. Project timelines stretch. Your optimistic forecast suddenly needs a neutral or downside scenario. The inputs changed, and so must the model. Monetary policy controls the money. Fiscal policy controls the purse, but together they shape the economic climate your model lives in. Want to get sharper at seeing these signals before they hit your spreadsheet? Subscribe for more episodes and concepts. Every modeler should understand.